There's definitely a bubble in the markets.
When AI stocks break, index funds won't cushion the blow. They're more likely to accelerate it, because passive money now runs the market, and passive money has no instinct for shelter. It tracks the index exactly as it's built, heavy at the top, loaded with AI. So when leadership cracks, the damage doesn't stay contained. It moves through ETFs, through flows, and into everything. For decades, investors tried to beat the market. Now most of them simply follow it. By 2024, passive investing had officially overtaken active management in U.S. equities. Through 2025, that lead continued to widen. Today, passive funds control roughly 53% of the market. That shift fundamentally changes how money behaves. Passive assets climb from about $1.6 trillion in 2010 to nearly $15.6 trillion by 2025. Most of that capital isn't making judgments on valuation, timing, or balance sheets. It's simply buying exposure. And when enough money flows through the same passive channel, market structure begins shaping outcomes more than fundamentals. The real problem isn't passive investing. It's what passive investing is forced to buy. The S&P 500 looks diversified from the outside. Inside, a small group of giants carries most of the weight. As of March 2026, 7 companies account for roughly 1/3 of the entire index by weight. NVIDIA alone represents about 7.2% of the S&P 500 and roughly 13.6% of the NASDAQ 100. That means one company now holds enormous influence over index performance and ETF positioning. So when investors say they're buying the market, they're often buying a concentrated bet on its leaders. And because AI defines that leadership today, a break in the AI trade rarely stays contained. When money enters an ETF, the fund must buy the underlying basket of stocks. If the index is top-heavy, inflows don't spread evenly. They pile into the companies already dominating the index. Now reverse that. When AI leaders start falling, the index begins falling with them. Investors pull money from the ETF, and the fund must sell the assets it holds. That creates more selling pressure in the exact companies already declining. Passive investing rarely triggers the first crack. But once the move begins, outflows add pressure. ETFs don't simply reflect a falling market, they can push the decline further. Markets don't always fall because investors panic. Sometimes the structure itself accelerates the move. In high-stress periods, liquidity dries up, spreads widen, and instruments built for convenience behave unpredictably. ETFs represented roughly 15% of trading volume in 2005, 25% in 2015. By 2024, that share reached about 27% and rises toward 32% during volatility. So when stress hits, you're not only watching investors react, you're watching a system execute rules. Automated systems move pressure quickly, from a single stock to an index, from an index to an ETF, from an ETF to millions of portfolios. AI is no longer a side theme. It's the center of market leadership. For many investors, the AI trade represented the clearest expression of growth. But the higher concentration rises, the less cushion markets have. When one company holds more than 13% of the NASDAQ 100, its movement reshapes the index. What begins as a company story quickly becomes a flow story. And sometimes a localized sell-off becomes a market-wide move. Today, the largest ETFs control hundreds of billions of dollars. That scale works well when money flows in. If you remember 3 numbers, remember these. They describe a market where passive capital dominates. The fall may not start with ETFs, but once it begins, they may make sure everyone feels it. Thank you for watching. I appreciate you taking the time to think through this with me.